Okay, let's conclude the chapter 7. We'll continue talking a little bit more about some ratios, and then we'll work our way to end with some concluding statements about financial analysis for a company. To measure leverage or debt, one of the ratios we can use is referred to as the debt-equity ratio. This essentially tells us the relationship between long-term debt and shareholder investment. So really it is just looking at how much money has the company borrowed long-term compared to how much investment the shareholders have invested in the company. The greater the number, the more risk that there is for the company. Obviously because debt has contractual obligations to it. But another way to kind of look at this is, if you're looking at a company, how much do you have at stake in the company? How much is your piece of the pie, if you will, as far as the ownership in the company? The greater this amount, the greater leverage there is, the more ability there is in good times for the company to provide great amount of returns. On the other hand, when times are bad, these losses ultimately are also magnified because of the lower investment that shareholders make. Times interest earned is a way of measuring leverage that really looks at a company's ability to make payments. So we take earnings before interest and taxes, EBIT, and you divide that by interest expense. So this just shows, look, the profitability of the company. If you remember, the numerator here, I've referred to this as operating income. So this is the operating profits or the operating income that is attributable to doing the business. It's what's left over after we've paid all the expenses of running the business. The next thing in line after EBIT is the I, is interest. So how much profit is there to cover the interest expense? And of course, the higher the ratio, the less risk there is, the greater the implied ability to make interest payments. Profitability ratios. One of the primary ratios we look at is called net profit margin. It's the net income, the net profit after taxes, divided by total revenues. And of course, with respect to profitability, higher numbers are always better numbers. So thinking about financial analysis, we would want to look at the history of the company. Is this number trending better or trending worse? Can I make comparisons to competitors? Can I make comparisons to the industry as a whole? So all of these different analyses are possible once we break down into these formulas that we refer to as ratios. Return on assets. It's the net profit after taxes, again, net income, divided by the total assets of the company. Again, a higher number is always better. This just talks about the profit that's available to cover or based on the actual investing in assets. So it talks about management's efficiency at using assets. Now, one of the things we might want to do, and we talk about this in some other courses, is you might want to actually change that numerator to EBIT so that it's operating income or profits divided by total assets. This will give you a better picture of how the company is running the business. It's really a much better efficiency number if you're thinking about looking at assets. So again, return on assets is a number that's generally talked about in businesses. We do have to be careful when we make some comparisons though. Return on equity, again, net profit after taxes, net income, divided by stockholders' equity or stockholders' income or investment. Higher numbers are obviously better. This just reflects the profits that are generated based on the investment of stockholder equity or shareholder investment. We can break these numbers down. This ultimately is something referred to as the DuPont analysis. But if you take net profit margin and divide it by total asset turnover, you would end up with a ratio called return on assets. So again, if you want to understand, like, why is the company performing poorly with respect to return on assets? The formula is net income divided by total assets. So do I increase net income? Well, sure, I'd like to do that. Should I get rid of assets to reduce the numerator? Probably don't want to do that. So looking at the return on asset ratio, it's difficult to understand how the company could improve or where the issues are with the company. So now if we take net income divided by total assets and multiply that by total assets divided by sales, we end up with return on assets. So again, it's a way of breaking this number down into profit and efficiency. Taking this analysis one further, if you take return on assets and multiply by what's referred to as an equity multiplier, again, you would take net income divided by total assets, multiply that by total assets divided by stockholder equity, you end up with net income divided by net income divided by equity. So, excuse me, what this shows us is that if you're really trying to figure out where a company is performing well and where they're doing poorly, there are ratios and formulas that we can combine to look at basic questions and decisions of management. So if we go back, what decisions are we interested in? Can management create profits? If we want higher return on equity, one way to get higher return on equity is just to make a greater profit margin, increase prices, increase revenues somehow, decrease expenses. We need to figure out a way to use our assets more efficiently, manage accounts receivable, inventory, just the general plant and equipment. Manage that more efficiently. If these two numbers go up, return on assets goes up. If return on assets go up, then obviously we can find a way, maybe return on equity will go up. And finally, this equity multiplier, although it's not really apparent from looking at it, is really a leverage number. If this number increases, it means that total assets is growing relative to equity, which means we have less debt. So if we increase the leverage of the company, we increase the equity multiplier. So again, how can I increase the return that goes to my shareholders? Increase profitability, increase efficiency, utilize leverage when I'm financing assets. There are some common stock ratios that we want to talk about, and we've talked about these in some other classes. So you may need to go out on the internet, go to YouTube, maybe get some better descriptions of what the PE ratio is. But this price equity ratio is just market price divided by earnings per share. It's a very commonly used ratio. It's used frequently in stock valuation models. We'll talk about that in the next chapter. But it is a way of looking at, how much money are people willing to pay to receive the profits of the company. So the higher the PE ratio, the more expensive the company is. And of course, if you're thinking about buying stocks, you don't want to necessarily buy very expensive stocks. You'd like to find stocks that are properly valued and might have lower PE ratios, reflecting maybe lower values that could increase. So we have a PE ratio. Here's the company for this Universal Furniture outlet thing that we were looking at, $139 million in earnings. They had $61 million in shares, so their earnings per share was $2.26. That calculation was shown in the financial statements a little earlier. If you divide that into this company's current market price of 41.50, this price earnings ratio is 18.4. So what does 18.4 mean? The average S&P 500 company is typically on average between 12 and 20. So if you're in that range, you're essentially in the valuation range of where the S&P 500 is. So if it gets much over 20, we might start thinking that the stock might be a little bit overpriced. If it's much less than 12, this might be a stock that's either in trouble or it's a company that is mispriced. It's underpriced. So now we want to take a look and figure out, that's one of the ratios, one of the things that we need to look at. Another ratio to look at is something called the PEG ratio. And the PEG ratio takes the stock's PE ratio and divides it by its 3 or 5 year growth rate in earnings. So what does this mean? If the PEG ratio equals 1, the stock price is in line with earnings growth. That means it is growing normally. It's an average kind of stock. If it's greater than 1, then this stock may be fully valued. What fully valued means is it might be overpriced. So the higher you are over 1, the more likely the stock price might be too high. And of course, less than 1 might be that the ratio or the stock price could be undervalued. So if we're looking for potential stocks that we might really want to look at, we want to pay attention to stocks with lower rather than higher PE ratios and lower rather than higher PEG ratios. The dividends per share is a very common calculation. It's just the amount of dividends paid to common stock divided by the number of shares. So this basically tells me how much relatively of the number of shares that are out there, how much did each share get paid with respect to dividends. If you think about the actual company and how much they pay out, we would like to have a relative number. So if you take dividends per share, the amount that was paid out, and divide that by earnings per share, which is the amount that could be paid out, this just gives you a proportion. As they say up above here, the traditional payout ratio is typically somewhere between 40-60%. Some companies are going to be much lower. There aren't a whole lot of companies that will be a lot higher, but companies are trending towards slightly lower payout ratios, and they've been substituting those lower payout ratios with repurchasing of stocks. So that is a current trend in companies. They're still paying dividends, but the payout ratio is actually being slightly reduced. If a company has a really high payout ratio, it's very difficult to keep and maintain high payout ratios. So those companies typically may have some challenges with their investors because they're going to have dividends that fluctuate. Their dividend growth doesn't always tend upward as in a growing fashion. We can look at something called the book value per share. The book value per share is what the accountants say the company is worth. The investment of shareholders is their equity. It's common equity. Now you divide that by the number of shares. And of course you would hope that a company would be worth more than its accounting value, since one of the things that we would like managers to do is to get the stock price to rise. So if we have rising stock prices, it's the norm that the book value per share will be less than the market value per share. In fact, we can look at that ratio. If you divide the market price of the stock divided by the book value of the stock, now we have a picture of the relative values, what the stock market says it's worth and what the accounting statements say the company is worth. A higher ratio means that this stock might be fully priced or overpriced. The higher the number, the more expensive the stock is to buy. And obviously the lower the number, the more likely it's underpriced. So again, we would like to find stocks with lower rather than higher PE ratios, lower rather than higher PEG ratios, lower rather than higher price to book ratios. These are all indications that the stock might be underpriced. Now that also could be an indication that the companies are in trouble. But again, that's where the analysis comes in. That's where the other analysis of ratios helps us to identify which of those companies are just undervalued and which of those companies are actually in trouble. So we can look at a lot of places to find ratios. There's different publications that are available. Standard & Poor's provides some stock reports. Those stock reports have some ratio analysis in it. So here's a picture from Mergent. Again, this is available, but this is not free. So if you go out here, you can find this information about the company. Quite frankly, as you peruse through most of this information, all of that information is available at Yahoo Finance. So we can get the information. Sometimes it's not in a nice, pretty form. We might have to search a little bit to find all of this data, but it is all available for us. So in conclusion, how can we interpret these ratios? We want to look at historical trends. How does our company compare to the industry? Maybe we can pull out one or two major competitors that we could look at. We just want to try to determine if the financial information is telling you a good story or a bad story. And once you know the definition of the story, is it good or bad, then you can start thinking about, well, maybe if it has a good story, maybe we should further investigate and try to calculate the intrinsic value. So moving forward, we need to kind of think about companies that might be in trouble. So what are the indicators that companies are struggling? If inventories and receivables grow faster than sales, right? Inventory's growing, sales isn't growing as fast. That means we're not selling as much as we should. If receivables are growing faster than sales, that means we're selling stuff, but almost all of it is on credit. If the current ratio is falling, we got to worry about liquidity. If the debt equity ratio is high and or is rapidly increasing, we have to worry about, are we going to be able to service this debt? Cash flow from operations, that number, really, we have to watch that number carefully. We have to have a positive number with respect to cash flow from operations. And in the end, we haven't even talked about this, but there are a whole series of issues and challenges that are referred to as off-statement accounts. So they're items or line items that are either not on the balance sheet or they're somehow incorporated into footnotes and other documents that we just don't know what they are because we don't see them. They're referred to as off-balance sheet accounts. You don't see them. So we have to worry about all of those things as well, and we didn't even talk about them in this class. So that's the end of chapter 7. In the next chapter, we're going to talk about the valuation of stock. How do we, once we've identified good story companies, how do we determine what the values of those companies might be?